VYM is absolutely crushing SCHD in 2025. And I mean crushing. While everyone's been preaching about SCHD being the king of dividend income investing, VYM has quietly been making investors significantly more money this year. We're talking about a performance gap so wide, it's making people question everything they thought they knew about ETF investing. But here's what's wild about this story. What I'm about to show you will completely flip your understanding of which ETF actually deserves your money. Because while VYM is winning the 2025 battle, the long-term war tells a completely different story. And by the end of this video, you'll understand exactly why one of these funds could be the key to your financial independence journey, while the other might just leave you disappointed. Let me show you the numbers that have dividend investors everywhere questioning their strategies. The performance gap. That's shocking everyone. Year to date, VYM is up 1.56% while SCHD is down 3.39%. That's nearly a 5% performance difference in just 6 months. For context, if you invested $10,000 in each fund at the beginning of 2025, your VYM position would be worth $10,156, while your SCHD position would be sitting at $9,661. That's a $495 difference on a relatively small investment. Scale that up to serious passive income money. On a $100,000 investment, VYM investors are ahead by nearly $5,000. But here's where it gets really interesting. This isn't just a 2025 phenomenon. Over the past year, VYM has delivered 9.54% returns compared to SCHD's 1.97%. We're looking at VYM nearly quintupling SCHD's performance over 12 months. This is the kind of gap that has investors scratching their heads about which ETF they should actually own. And when I dug into the data on Seeking Alpha, the picture became even clearer. The hidden differences that explain everything. See, most people think SCHD and VYM are basically the same thing. Both are dividend-focused ETFs with low expense ratios of 0.06%. Both have massive assets under management, SCHD at $68.21 billion and VYM at $59.18 billion. But their holdings breakdown tells a completely different story. VYM's top holding is Broadcom at 4.79%, followed by JP Morgan Chase at 3.72%. Look at those financials. They make up 20.91% of VYM's portfolio. Then you've got electronic technology at 13.36% and health technology at 10.26%. SCHD, completely different beast. Coca-Cola, Verizon, and Cisco all sitting around 4.3% each. But the real difference is in the sector allocation. SCHD is heavily weighted toward consumer defensive stocks at 16.61%, health technology at 14.56%, and energy at 14.08%. This difference in holdings explains exactly why VYM has been crushing it in 2025. Financials have been on fire this year. Higher interest rates have been a goldmine for banks and financial services companies. Meanwhile, SCHD's heavy weighting in defensive sectors like consumer non-durables and utilities has acted as a drag during this period of economic optimism. But there's something even more important happening beneath the surface. The smart money story. Fund flows tell the real story of where sophisticated investors are putting their money. VYM has seen fund flows of $450.98 million over the past year. Decent, but not spectacular. SCHD? A massive $13.72 billion in fund flows. That's over 30 times more money flowing into SCHD than VYM. So why is VYM outperforming despite having significantly less new money coming in? This is where ETF mechanics get fascinating. SCHD's massive fund flows actually tell us that retail investors, people like you and me, have been piling into SCHD based on its reputation for dividend growth. But sometimes, massive popularity can work against a fund's performance in the short term. When everyone's buying the same stocks through SCHD, it can create temporary price distortions. Meanwhile, VYM's more diverse holdings across 590 companies versus SCHD's concentrated 103 holdings has allowed it to capture broader market gains. Quick side note, if you want to dig deeper into this kind of analysis, I've got an affiliate link below for a 7-day free trial to Seeking Alpha, where I pull all this data from. Just being transparent that it helps support the channel. But here's where this story takes a dramatic turn. Because while VYM is winning today, The long-term picture completely flips the script. The long-term twist that changes everything. Pull up the 10-year performance chart and prepare to have your mind blown. SCHD, 102.70% total return over 10 years. VYM, 89.18% total return over 10 years. Wait, what? Over the past decade, SCHD has delivered 13.52% more total returns than VYM. And this isn't just about price appreciation. This is the total picture including dividend income. But the real kicker, dividend growth. SCHD's dividend growth over 3 years has been 11.26% compared to VYM's 5.95%. Over 5 years, SCHD has delivered 11.44% dividend growth versus VYM's anemic 1.67%. This is huge for anyone thinking about living off dividends. Let's say you're planning for retirement income and you want to live off dividend income. With SCHD's current dividend yield of 3.92% and its track record of 11% plus annual dividend growth, your income stream grows dramatically over time. VYM's current dividend yield of 2.83% looks attractive, but with dividend growth averaging just 1.67% over 5 years, your purchasing power actually decreases when you factor in inflation. For someone seeking financial freedom through passive income, this difference is massive. If you invested $500,000 today planning to replace your salary with dividend income, SCHD would generate $19,600 in year 1. With 11% dividend growth, that becomes $21,756 in year 2, $24,150 in year 3, and $26,807 in year 4. VYM would generate $14,150 in year 1. With 1.67% dividend growth, you're looking at $14,386 in year 2, $14,626 in year 3, and $14,870 in year 4. Over just 4 years, SCHD's income advantage grows from $5,450 to $11,937 annually. The quality factor nobody talks about. Here's something most investors completely miss when comparing these ETFs. SCHD doesn't just buy any dividend-paying stock. It specifically screens for dividend quality using fundamental metrics like return on equity, debt-to-equity ratios, and cash flow coverage. This quality screening is why SCHD holds only 103 companies compared to VYM's 590. SCHD is essentially the cream of the crop when it comes to dividend-paying companies. VYM, on the other hand, simply tracks high dividend yield companies in the broader market. It's more of a dividend yield play than a dividend growth and quality play. This fundamental difference explains why SCHD has been able to deliver superior dividend growth over time. When you own the highest quality dividend payers, those companies tend to have the financial strength to consistently grow their dividends even during economic downturns. Think about SCHD's top holdings: Coca-Cola, Verizon, Cisco, Lockheed Martin. These are companies with moats, pricing power, and decades of dividend payment history. They're not just paying dividends, they're growing them consistently. VYM's approach captures more companies, which provides diversification, but it also means you're holding some lower quality dividend payers that might cut their dividends during tough times. The sector rotation reality. Here's what's really happening in 2025. We're in a period of sector rotation where financials and technology are outperforming defensive sectors. VYM's heavier weighting in these growth-oriented sectors has given it a temporary advantage. But sector rotations are cyclical. Consumer defensive stocks, health technology, and energy, SCHD's core holdings, have historically provided more stable dividend growth over long periods. Think about it logically. Companies like Coca-Cola, Altria, and Johnson & Johnson have been paying and growing dividends for decades through multiple economic cycles. Financials and technology companies, while profitable, tend to be more cyclical in their dividend policies. This is why SCHD has maintained 13 consecutive years of dividend growth while delivering superior long-term returns. The math behind financial independence. Let's get specific about what this means for your financial independence journey. If your goal is to accumulate enough passive income to replace your salary, dividend growth is absolutely critical. Here's why. Say, you need $60,000 annually in dividend income to replace your salary. With SCHD's current 3.92% dividend yield, you'd need about $1.53 million invested. But here's the beautiful part. With 11% annual dividend growth, that $60,000 becomes $66,600 in year 2, $73,926 in year 3, and $82,058 in year 4. Your passive income is growing faster than inflation without you having to invest another penny. With VYM's 2.83% dividend yield, you'd need $2.12 million to generate that same $60,000 annually. And with only 1.67% dividend growth, your income barely keeps pace with inflation. The difference is staggering. SCHD gets you to financial freedom with $590,000 less capital required, and then grows your income faster once you get there. This is the power of focusing on dividend growth rather than just dividend yield. The tax efficiency advantage. Here's another factor that heavily favors SCHD for long-term dividend income strategies. Both ETFs pay qualified dividends, which are taxed at favorable capital gains rates rather than ordinary income rates. But SCHD's lower turnover rate of 29% compared to VYM's 13% actually favors VYM slightly from a tax efficiency standpoint. However, the dividend growth story more than makes up for this small difference. When you're building passive income for retirement income, you want dividends that grow over time. SCHD's superior dividend growth means you'll likely need to make fewer taxable transactions to maintain your desired income level. With VYM's slower dividend growth, you might find yourself needing to sell shares or add new capital more frequently to keep up with inflation, creating more taxable events. Making your decision. So which ETF should you choose? If you're looking for short-term performance and believe financials will continue outperforming, VYM might be your play for the next year or two. But if you're building a dividend income portfolio for financial independence, if you want to live off dividends in retirement, or if your goal is to replace your salary through passive income, SCHD's superior dividend growth track record makes it the clear choice. The data doesn't lie. Over meaningful time periods, SCHD has delivered better total returns while growing its dividend income at a rate that actually outpaces inflation. The key is understanding what you're optimizing for: short-term performance or long-term passive income that can actually replace your salary and fund your financial independence journey. Whether you're just starting your ETF investing journey or you're fine-tuning a dividend income strategy for financial freedom, understanding these fundamental differences between dividend yield and dividend growth strategies makes all the difference. VYM is winning the 2025 battle because of favorable sector rotation, but SCHD is winning the long-term war because of superior dividend growth and more sustainable passive income generation. If your goal is financial independence through dividend investing, if you want to build retirement income that grows over time, or if you're working toward the day when you can live off dividend income, the choice becomes clear. SCHD's track record of dividend growth, combined with its quality-focused holdings across defensive sectors, makes it the better choice for serious dividend income investing. VYM has its place for tactical plays and shorter-term positioning, but for building lasting financial freedom through ETF investing, SCHD's consistency in dividend growth and total returns speaks for itself. The data shows which ETF delivers on the promise of sustainable dividend income growth. Now you just need to decide which path aligns with your financial freedom goals.